Hi everyone, this is Gary Wilson and welcome to this week's live Investor Agent Workshop. Also welcome aboard to all of the students who've been through the other programs like Flipping for Profits, rental profits without the pain, wholesaling, and also turning rental problems into real estate profits, which is on, of course, property management. We are live. We are now recording. If you're new to the group, welcome aboard for all of you. Also, welcome to all the veterans. We got pretty much a full house here tonight. Welcome to the Canadians who are on board here too. If you're new, just so you know, you can use your question box to type in questions. We'll be checking questions periodically throughout the webinar and answering them. Also, last but not least, we got a special guest, Ken Wimberly, a broker with Keller Williams, and he's an OP, has a market center, and has been a top agent in the Dallas area, and is specialized in net leases. So Ken and I are in the same mastermind group. We've known each other for probably 2 years now. He's an awesome guy. I taught at his market center. And Ken, I want to welcome you personally and also on behalf of the group. Thanks for joining us and bringing your time, energy, and effort, and most importantly, your knowledge of this field. So welcome aboard, Ken.
Well, thank you. Thank you for having me. Am I still coming in clear?
Yep, we can hear you loud and clear, man. That's awesome. And hey, real quick, Ken, if you wouldn't mind, this is sort of an informal group. Would you mind just giving people just a real quick, hey, here's who Ken Wimberly is, and then I'll go ahead and you've got control. At that point, you just go right into the content.
So I am Ken Wimberly. I've been in the commercial real estate business since 2002. And I've been in the real estate business since 2002, and I've never sold a house. Actually, I've sold 4 houses, and I've used a residential realtor to help me in the sale of all 4 of those, even though I was licensed through 3 of them. So I was in the land business for many years, and then joined KW Commercial in October of 2009, kind of in the infancy of KW Commercial, and I obtained my CCIM in 2010, which, for those of you that don't know, the CCIM is the Certified Commercial Investment Member, in essence the equivalent of an MBA in commercial real estate finance. Started building a team in 2010, started with me and an admin, and now we've got 14 folks in our group, and we had decided to focus on triple net investment properties in 2012, and by 2013 we went exclusive. Basically referred out all of our other existing business, which was a lot of land deals, referred those out, went exclusive into the triple net investment world in 2013. So KW Net Lease Advisors is my commercial real estate net lease investment company. We're really a brokerage company with an investment company, although we do, as individuals and team members, invest in some properties as well. In 2012, we did $22 million in sales volume. 2014, we did $70 million in sales volume. In 2016, we jumped that to $109 million in sales volume. And we expect to exceed $200 million this year. So we are definitely growing. We're actually rapidly growing these days, always looking for highly intelligent, motivated, and talented individuals. So I heard you say, Gary, grab a pen, pencil, and notepad. Thank you very much for that, because I encourage everyone to please take notes. Taking notes enhances your learning. It reinforces your learning. I am happy to give out a copy of the slides. In fact, if as we get through this, if you will, and I'll show this slide again at the end of the presentation, but if you will complete a survey at surveymonkey.com/r/Wimberly, I will email you. There's a place that if you'd like a copy of the slides, you can add your email address, and we're happy to email you an entire copy of the slide deck here so you can have those as well. And I will be, if you'll raise your hand or submit a chat, Gary will be reading the questions throughout this. So if a question comes in, and I'm happy to stop and pause and answer it as we're at the appropriate subject. So basically 2 things I'd like you to get out of this evening, and that's to be able to answer a couple questions. One is, what is a net lease investment? And number two, how can I benefit from this knowledge? Okay, many people have no idea what a net lease investment was, and frankly, before I started getting into this business, I mean, I'd been in the commercial real estate business for 10 years before I got into this, and I really had no idea what a net lease investment was. But what is a net lease or triple net investment? Well, triple net, what it is in essence is a property leased to a tenant under a triple net lease. And these leases, triple net leases, are typically long-term leases with terms often lasting 10 to 15 years, sometimes even more, where the tenant pays for real estate taxes, insurance, maintenance of the property, and they pay those in addition to any rent, utilities, janitorial, etc. There may or may not be rental increases in the primary term of the lease, and after the initial term, the tenant typically has options to extend the lease for a fixed increase in the rent amount. And there may be multiple options there, but the terms of those extensions are generally defined in the lease. And then the owner of the property receives a monthly income check, frankly, often by direct deposit, and enjoys favorable tax benefits of the property. And when we talk about the triple net or three nets, what we're referring to is taxes, insurance, and maintenance of the property. And so these three items are what's commonly referred to as NNN or triple net, the three nets. So when just kind of learn that if when we talk about triple net leases, it's the tenant taking care of some or all of these components right there. Now, not all leases are created equal, okay? So this little diagram shows a spectrum of lease types. And all the way on the left, we start with our gross lease. And then a gross lease, the landlord typically pays, or will pay the taxes, insurance, maintenance, and the tenant just pays their rent. They'll pay the rent check, and they'll have utility bills is what they'll have, but their own suite utility bills, not utilities for the property in general. With a modified gross lease, so the office building I'm in right now, we have a modified gross lease. So we as a tenant pay our base rent plus a negotiated share of the expenses. So I have a base stop lease where all of the expenses above the amount that were being paid the year I moved in there, the tenants pay their pro rata share of that. So there's a modified gross lease. Then we move into a net or double net lease. And with the double net lease here, the tenant typically pays their taxes and insurance of the building, and the landlord typically pays for some or all of the maintenance expenses right here. And so there's a big variety, and they say that the devil's in the details, and that's very true in these leases. On to a triple net lease. With the triple net lease, the tenant pays taxes, insurance, and maintenance. And the landlord, typically the landlord would actually pay those bills, and they would bill the tenant back for as a additional rent throughout each month. And lastly, on the absolute net lease, also called a bonded lease, landlord has no responsibilities, and this is including no roof, no structural, no foundation issues for the landlord. It all falls onto the tenant. And in fact, many times in an absolute net lease, the tenant will actually write the check and pay the tax bill, pay the insurance bill, pay all the maintenance, and they'll just write it direct. It's as if they owned the building. They're kind of treated like as if they owned the building in the absolute net lease. So who leases these kind of things? What are the triple net properties? These are a few tenants that you probably drive by every single day and may not know that these tenants don't actually own their real estate. But the ones you're looking at right here typically do not own their real estate. Many times they are simply tenants, and there is a third party, either a developer or an investor, that actually owns the real estate. And these are many of the tenants that we deal with and transact. There's many, many, many more, but these are certainly some recognizable names that you may recognize. So let's talk about a few of the benefits of investing in a triple net property. Number one, safety of principal. Okay, these triple net properties are typically leased to very financially sound tenants that have corporate guarantees on the leases. So if for some reason the tenant went dark in a location. You'll see this happen on occasion where a tenant says, you know what, we're just not making money on this location, we're going to go dark. But if for some reason that happened, with the strong corporate guarantee behind them, the tenant would still pay for the remaining number of years worth on their lease. So it's generally a very safe investment. Number two, cash flow. Okay, unlike investing in the stock market, the triple net investments provide a stable, secure, and predictable monthly income. Next, low maintenance requirement. Because again, we're talking about the tenant takes on most or all of the maintenance obligation of the properties in these assets. Then low management, especially with single tenant properties. Now with multi-tenant, it gets a little different. There's more management required. But when we're talking about single tenant, triple net properties, the rent is often wired to the landlord's account, so you can literally check your bank account, receive your funds while sitting on the beach. Another benefit is appreciation potential. Appreciation comes from a number of things, including rental increases in the lease term. As that happens, the property is appreciating in value. Favorable market conditions can, certainly in the last few years, cap rates have compressed. There's been much more demand for these type of properties, and the values have increased. And then also there's appreciation potential from tenant credit enhancement. So if the tenant credit gets stronger, or perhaps if a tenant vacated and you replaced it with a stronger credit tenant, there is appreciation of your property right there. And lastly, not unique to triple net properties, but certainly a great benefit of real estate are tax benefits, including depreciation, cost segregation, and my favorite, the 1031 exchange. And my favorite little component of the 1031 exchange is what we call the swap till you drop. And in essence, what that is if you use a 1031 exchange when you sell your property to then go purchase another property, you can defer your tax benefits. And if you do that over and over and over again throughout the course of your lifetime, when you die, your heirs receive a step up in basis at the time of your death. So commonly known as the swap till you drop, one of my favorite tax strategies there. So who owns net lease properties?
Hey, Ken.
Number one are developers. Yeah, go ahead.
Oh, hey, sorry. You got time for a quick question here?
Of course.
Looks like a quick one. It's this is from Carlos. Hey, Carlos, how you doing, buddy? So Carlos is asking, are absolute leases primarily used for sale and leaseback transactions?
Not just that. No, there are a number of tenants that will execute absolute net leases, and not all sale leasebacks will end up being absolute net, although some are. You know, in fact, the true absolute net lease is somewhat rare. What we see more often than not are triple net leases where there is some minor landlord responsibilities. Typically, it's for roof and structure is what we see. But with new build assets that have 20 or 30 year roof guarantees and of course new structural guarantees on it, with new build assets you generally don't have an issue as a landlord, but those are more often than not some of the responsibilities that will remain on the landlord's side of the ledger there. Okay, cool. So, thank you. Anything else?
I think that, let me do a quick check here since we got your pause. Yeah, that was, so far we're all caught up.
Okay, yeah. Cool. So developers, it's their job to go and do site selection for these tenants. We work with a lot of preferred developers for some of the major tenants, and so their job is they'll go find suitable sites for tenants. They'll put the site under contract. They'll make sure that the site is a suitable site from a zoning perspective. They'll make sure that they've got the right traffic counts, the right demographics, what the tenants are looking for. Then they'll go submit those sites to the tenant committees, get the site approved, get a lease negotiated, and once that's all done, lease is executed, then the developer will close on the property, construct the property, and turn it over to the tenant. Typically, the developers are what we call merchant developers, and they're usually selling the assets once the tenant has occupied the building. And so we do quite a bit of business with developers that own these assets. institutional funds and endowments, especially over the last 5 years, institutional money has started flowing into the triple net investment world. Family funds. So there are wealthy families out there that have net worths of $50 million or more that create these family offices. And so, again, with the family offices, much of those funds are now starting to place a portion of their wealth and their investments into the triple net investment world. REITs, so real estate investment trusts. There are some REITs devoted entirely to single tenant triple net assets, and so, but even the major REITs that are in the retail world usually have a solid portfolio of these type of assets. And lastly is high net worth investors. So much of our business comes from, especially on the buy side, from high net worth investors. And this is where probably one of the most likely opportunities that you all may have to come in contact with folks in this world are guys that are maybe selling out of an apartment. You got tired of the management of the apartments, or selling out from a portfolio of single families that they built over the years. I said, man, I'd really like something that is kind of hands off and easy to own, and this is an easy transition into what we do. So keep that in mind. So a few examples of sales that we've recently done at KW Net Lease Advisors. This is a recent dollar store we sold. We sell a lot of dollar stores every year. Next one's a National Tire and Battery in the auto parts and accessories world. And a Family Dollar. We sell more dollar stores than Family Dollar, but a fair amount of Family Dollars as well. The next was a multi-tenant medical office building, followed by an AutoZone, and then lastly was a single-tenant vet clinic. So all of these were in the last couple of months that we had transacted. So when it comes to valuing triple net assets, remember IRV. And if any of you have taken finance classes in college or CCIM classes, you'll remember this is your valuation formula, and that's income divided by rate equals value, or restructured and looked at another way is the price of a property equals its net operating income divided by the cap rate. And there's an inverse relationship between price and cap. Okay, so the fixed component here is the income, right? So when a tenant executes a lease with the developer, there's a fixed income. So in this example, if it was a $10,000 rent payment per year, and the investor paid $100,000 for that, he would be getting a 10% cap rate. Okay, as a buyer, we want a high cap rate. As a seller, you want a low cap rate. So to carry that on down, if the seller said, no, I'm not going to sell that for $100,000, this could be $110,000. Well, you're still just getting the $10,000 NOI, so that $110,000 purchase price would then equal a 9.09 cap rate. And to take it a step further, if the seller acquired $120,000, the cap rate would then drop to 8.33. So the higher the price, the lower the cap rate on there. So leverage in triple net. So most of the properties we transact involve some type of leverage being used on these properties. We'll have about 10 to 20% of our deals that are all cash, typically 1031 exchange properties, or investors coming in to buy that have to place all cash. But many of the properties we sell involve some type of leverage. And there are lenders that specialize in the triple net asset class, and it's really important, much like in the single family world and in the apartment world, but it's important to get a lender that understands the asset class. With these type of loans are generally 65 to 75% loan to value. Personal guarantees are typically required unless the loan to value gets lowered into maybe the 50% loan to value range. And if you get it down there, then we get it without a personal guarantee. Amortization rates for these are typically 20, maybe 25-year amortization rates. Interest rates reset every 5 to 7 years on these. So it is very rare that you're going to see a fully amortizing loan on these types of properties. It just they almost always have some type of interest rate reset on them, and typically 5 to 7 years. So a few major considerations when thinking about buying triple net properties or talking to investors about buying triple net properties. Number one is always location of the property. Location matters. Things to think about in terms of location is what's the population of the surrounding area. A lot of these dollar stores end up in really small tertiary markets that maybe only have 500 or 600 people in the entire town. Now, the store is pulling from a larger population of a county or even a couple of counties sometimes, but you got to think about what's going to happen with that asset if the tenant ever goes out. So location matters with population, with traffic counts, with access issues. Sometimes you can have a great location in theory, as far as maybe visibility is dynamite, traffic counts are great, but accessibility is a real challenge. So it's important to think about a variety of factors when considering location of property. Next is the financial strength of the tenant. Okay, not all tenants are created equal. Some are large publicly traded corporations. Others are mom and pop operators or maybe franchisees that have just 1 or 2 units. Think about Taco Bell. This is a great example. Taco Bell might have one store that is a corporate guaranteed lease, might have another that one of their major franchisees has, and they're guaranteeing the lease. Say they have 200 or 300 units. And then another might be one of the brand new franchisees that has 1 unit, it's their first unit, and the value of that lease is different on all 3 of those situations. Next thing to consider are what are the landlord responsibilities. Okay, we talked a little bit about the roof, the structure, could be parking lot, could be a number of things that might be on that landlord side of the ledger, and the devil's in the details in these leases, and it's really important to understand what some of the gotchas are for the landlord. We don't see this all the time, but it happens. It shows up in leases, and that's buyout provisions and early termination options. Important to look through the leases and understand, because when these happen, I'm dealing with a property right now that that tenant outgrew the space, moved out of the property early, and they've got a buyout provision that gets them out about 1.5 years early from the lease. So as we look to try to sell this for the landlord, this is a real factor that comes into the property. So rental increases in the primary term. Okay, given the choice of either a flat lease or a lease that had rental increases, you would choose, all other things being equal, the one that has rental increases in the primary term. Many of the medical office leases or the medical leases will come with even annual increases. There might be 1 or 2% annual increases in the primary term. Some of the new dollar store leases are out there for 15 years flat. Some of the CVS and Walgreens are 25 years flat. And so that's an important consideration to think about, because, again, when you're valuing these, when you think about hedge against inflation, all the little details come into play. Rental increases in the lease options. I've actually seen leases that the rent goes down in the lease options. So that's an important thing, because the options in a lease benefit one party. Okay, that's the tenant. Landlord does not benefit from having options in the lease because it's a one-way exercisable deal. The tenant says, I will exercise it. If market rents have fallen and the tenant has an option to increase it higher than market rent, guess what? They're going to negotiate you down as the landlord. That, or they're going to be, they're going to move out of the property and go get where market rents would be. So keep in mind that rental or lease options benefit the tenant only. So market rate rental comps. What I mean by that is many times some of these tenants in the market will pay very high rental rates to be in a location. So, for instance, if you've got a $20 a square foot rental market for most retail tenants, and you've got let's say an AT&T corporate store that's paying you $45 a square foot. I've seen this happen. It sounds great, especially if you're the seller on this. That's great. You're going to sell based on a $45 a square foot number. But if you're buying that asset, you may be getting a nice, strong return coming from the AT&T corporate store. But if they ever go dark, if they decide not to renew when their renewal comes up, or not to extend the lease, and they go dark, and you're in a $20 square foot market, and you bought an asset based on a $40 or $45 square foot rental valuation, you've just lost half of the value of your property. So it's important to really pay attention as you're representing folks on these. The size of the property for alternative uses, okay, a 1,500 square foot, Tidal Max, for instance. I'll go into some of these little small things, and, Tidal Max is pretty consistent tenant paying rent right there, but if they go dark, you have a real limited pool of options with a small size of the property. Likewise, if you have a really large, a mid-size or big box property, you have a certain number of options that are only available to you for those properties. So thinking through the size of the property for alternative uses, important to consider when buying. Restrictions that limit alternate uses. Sold a property a number of years ago that was an out parcel to a Target Power Center, and it was riddled with deed restrictions. It was actually a chicken concept that was in there, but not only could we not put more chicken concepts, we couldn't put burgers, we couldn't put certain sports bar uses, we couldn't put all kinds of things in there. So it was really kind of handcuffed us on our alternatives. And then lastly, I'd say is knowing what the gap or void analysis is like in the market area, because if especially if you're buying more of a short-term or shorter-term lease right here, thinking through in terms of what happens if my tenant goes out. Benefit of buying a shorter-term deal is your yield is typically higher, okay? But with those, if the tenant goes dark, you got to figure out what can I do. And so we're talking about the gap and void analysis. There are programs that we can use to identify how much consumer spending is being spent in a geographic radius, and what kind of tenants are missing in that radius that would be natural fits for replacing properties there. So question for you all is, how can I benefit from this knowledge? Hopefully a couple of ways. Number one would be, if you're in a place to start investing in these, that you know a little bit more and your eyes will be open to look at these personally. But number two is, if you are representing clients and representing high net worth clients, you can benefit from a really easy referral phone call to people you know in this business. And I'm hoping that you might, understand that knowing us could be a benefit to you. So here's a real life referral scenario that happened this past year. Got a $3 million 1031 exchange buyer that came from a land parcel that was being sold in California. They made an introduction to us, 5-minute phone call. The buyer purchased a triple net retail property in Texas, and through that, we earned a 2% commission, which is a $60,000 fee, paid a 20% referral. So for a 5-minute phone call, the referring agent got a $12,000 check, and all it took was them knowing who to call for that. And not just that, though, but making a real introduction to us. It's one thing, there's a whole lot of people tire kicking and looking for things out there, but the agent had a relationship with the client, and they introduced us as their partner. They knew us, they knew that we would take care of them, and then we were able to execute a fiduciary relationship with him, and absolutely we sold a couple of dozen properties to get the right one to work for him. So relationships, like everything, are key. So who are we? KW Net Lease Advisors. So we were the #1 commercial group in all of KW Commercial last year, #1 dollar store broker in the state of Texas, #1 auto parts broker in the state of Texas, and we have a nationwide reach. So through the KW network, we're able to transact in any state in the nation. If there's not a KW broker of record partner that we have an attorney that is licensed in 40 some odd states, and she represents us in the states where we don't have a broker of record partner. We're members of the CCIM Institute, of ICSC, Society of Commercial Realtors. So we're heavily involved in the business, and all we do is commercial real estate. And within that commercial real estate world, it's a very narrow specialty in this net lease real estate. So
Hey,
in
Ken.
all the classes I teach. Yep.
Oh, I'm sorry.
Questions?
Hey, real quick, just so people know on the webinar tonight, there are agents from several other organizations. And some of them are small, like geocentric around, say, Phoenix or LA and New York, shit like that, and even some larger brokers are like Remax. And I just want to know they can participate in this too, right? I mean, in other words, if any of you guys on this webinar, or if you're listening to a recording after the fact, and you come across an opportunity, like one of your clients calls you, or it's just you just whatever reason you're involved in a transaction like this, you're not sure, and you don't want to lose that deal. I mean, it sounds like, Ken, they can call you, and perhaps you can help them participate and get some money like that referral fee. And who wouldn't want to get a $12,000 check,
Yeah. By
My
all
gosh.
means, and no, in fact, one of my best referral partners is an Abby Halliday agent, and she sent me some of the largest referral deals I've sent out is from this lady, and she's just well connected. She's connected with business owners, and she keeps things top of mind, and when she sees an opportunity, she picks up the phone and makes an introduction. So, by all means.
Okay.
By all means. So,
well, I've got some questions. Is it now a good time to bring up a few questions?
Yeah, we can hit questions.
Okay, so this is from John Barnes. Hey, John. So John is in the Golden State of California, south of LA, almost to San Diego. Okay, his question, why wouldn't a company like Starbucks or Dollar General have an in-house site development and construction team if they're doing multiple locations? And then the follow-up is, at what point does it become beneficial for them to keep it in-house? So that's a good question, because I know in the past there's a company called Sheets. You probably heard of Sheets, Ken. They're up in the east and northeast and mid-Atlantic, and they were growing like gangbusters for a while. And they actually, this is in Ruckersville, Virginia, small metropolis, one-light town. They did a 99-year lease on a corner property. This guy owned, he was 98 years old, and Sheets did a 99-year triple net lease with him that his heirs ended up inheriting. And it's kind of an interesting situation. We found out that people, I don't know if you do this too, Ken, at least unless I've understood this correctly, the people that own the property can actually sell that triple net lease. It's like a commodity that they can sell, and then the person that buys a lease gets the income coming from, in this case, Sheets, and then the owner of the property got a one-time payout. They still own the property.
That's what we do. That's what we do every day. That's right. We help folks buy and sell these assets.
It's amazing.
And the question, though, about why wouldn't they keep it in-house? So Starbucks is opening 1,500 units this year. Okay, so in order to open that type of unit volume, you need a lot of folks on the ground. And so they'll have folks that they have relationships with that are their preferred developers that they do business with. Dollar General's opened 1,000 units this year. 1,000 new units are opening. So in order to do that kind of volume, it's very difficult to do that all in-house. So they certainly have a lot of in-house folks, but it's very difficult to do that kind of unit volume all in-house. So that's the big reason on this.
Awesome. Okay. And then this, thank you, by the way. And then this is from Willett. She is asking, okay, where would you find the cap rate for your area? So is there, that's a good question. I know I'm able to find it myself by digging around anywhere I go, but is there a place you can think of, Ken, that maybe is accessible to everybody? They could drill down at the state level and local level for their areas. Maybe it's a CCIM source,
What are we talking about when you're saying find the cap rate for your area?
Yeah, like what would be a good cap rate for the area? So let's say she's in Columbia, South Carolina, and I know there's actually macro levels and micro levels, but like what?
Yeah, so CoStar puts out. I mean, there are a few organizations, including CoStar and Reese, that put out quarterly and annual reports that will kind of show cap rate trends, and it's the trend is more tenant specific than location specific. I'll tell you that. So it's not like you can say, well, in Charlotte the average cap rate is 7.75, because it's going to vary widely depending on the tenant you're talking about. So, but the major real estate organizations and data organizations do put out some reports, and I know Reese puts out reports that are metro specific. So it will drill down and it'll look at, okay, big box cap rates in DFW, and then it'll look at strip center cap rates, and they'll look at everything that's traded over a certain dollar volume, and it will produce reports of that. So you can go look up Reese reports to find the REIS reports.
Awesome. Thank you very much. So we're caught up on questions. Go ahead. I see some awesome books here. You want to fill us in on? I've read 5 of them.
Okay. Well, there's 8 books to change your life, and I believe in these books so much that in every class I teach, and this just started 2 weeks ago when I gave this bounty out for the first time, I'm putting a $500 bounty of my personal cash to the first person that will read all 8 books and then report back to me with a summary of each one of the books and a summary of the action steps that they've taken as a result of each one of the books. Okay, because these books will change your life. Miracle Morning, I would almost read these in order like I've got here, but the Miracle Morning is specific action steps to help you develop into the best person you become. Think and Grow Rich is all about mindset, written in the 1930s and still applies 100% today. Total Money Makeover. So too many of us have great incomes and spend it all. So that's a book about how to take control of your personal finances with specific action steps. It starts with food. It's about the powerful connection between healthy body, healthy mind, and teaches what specific foods do as they interact with our bodies with regard to inflammation and disease. The One Thing is about getting rid of distractions in your life that are keeping you from realizing your full potential. The last lecture is how to live the life of your dreams. Very powerful little book with lots of life lessons in there. The Slight Edge is similar to Think and Grow Rich, presented in a different context. It really resonates well. And lastly, Wooden on Leadership. I just read that this past year. Incredible grandfatherly leadership advice that's timeless with a proven formula for winning. Okay, so again, there's my bounty. You've got my email address. First person that actually does this, and for me to pay $500, you will be interviewed on this to make sure that you've read them. But that's out there. Next is just, these are my top business building books. Okay, phenomenal books if you're looking to scale and build a business. So again, if you I can't recommend, especially start with E-Myth, that what I just reread. And then, of course, if you will complete the survey on here, if you'd like a copy of the slides, give us your email address. If you want to remain anonymous, just remain anonymous. And but if you want a copy of slides, give me the email address, and our office will send you a copy of all the slides. So I'll be happy to answer any other questions, but thank you for having me.
Well, Ken, that was awesome, and that's was funny as I recognized a lot of those books, and there was one more I read. I just couldn't make out the title at first, but it was the last lecture, and that was the professor from Duquesne University. And of course, you might remember I spent 23 years of my life living in Pittsburgh, or Carnegie Mellon. I'm sorry, yeah. And I never met him, but I know people that knew him personally. And for people who don't know, he unfortunately lost the battle of the cancer, and his last lecture was to his students, and I met a couple of them just because I had so many properties up there, and they said it was a real tearjerker. The guy stood up there and basically poured out his heart, and it was an awesome book, you know.
Book was amazing, and you can YouTube the last lecture and watch his last lecture.
Yeah. I mean, what a way to keep things in perspective, really make you think about what's really important. And, you know,
yes,
we're always so used to looking ahead at the next transaction, the next deal, and whatever, the next plan. And the fact is, most of what's enjoyable in life is sitting right here in front of us right now, you know. So,
yes, sir, it is.
Hey, let's see. We do have a couple questions popping in here. Hang on one second. Let's see. Let me go back. This is from Sarah. Hi, Sarah. She's asking, can you please show business building book slides again? I guess that was the second book slide.
Oh, of course. There we go.
Yeah, so I've got Scale. We just got that one in there.
Yeah, so Scale, and that's a phenomenal book. That's a really good book. E-Myth Revisited, of course, is great. Double, Cameron Harold wrote that. the sales acceleration formula was written by a Mark Roberg, who was an MIT engineer who was hired to build HubSpot's sales team. Okay, so he approached building a sales team with an engineering perspective, and it was wildly successful. So another great book. Scaling Up, Vern Harnish was founder of the Entrepreneurial Organization. Of course, Jeff Hoffman was founder of Priceline that wrote Scale. And then Matter was actually a Gary Keller recommendation, another great book about becoming kind of the obvious choice amongst your competitors.
Mm-hmm. Wow. Yeah, I tell you what, anybody out here who wants to build a team, you definitely should be reading the E-Myth, that's
yes.
I mean, if you ever met Michael Gerber, his most he was in San Diego for, I don't know if he's still out there. I saw him. I didn't get to meet him in person. I saw him. He was wearing like board shorts and a Hawaiian shirt and a beard and scraggly. It's funny he's saying, but the book goes back to, I think the original book, I think was like in the 90s or something. I can't remember, but one of the absolutely foundational. I mean, like Think and Grow Rich kind of foundational,
Yep, absolutely.
So let's say, hey guys, tell you what, if you got questions, now's the time to key them in, because we got Ken on board, and he's a busy guy, and we certainly appreciate and respect his time. Okay, hang on one second. There is a question here. Let me go back down. This is Michael. Hey, Michael. Okay, Michael is asking, okay, what do you think of the concept of some investors saying that retail is dead, hence Amazon, eBay, etc., changing the game? So I guess you're looking for your opinion on brick and mortar retail versus the online stuff.
Yeah, I mean, it's certainly a changing game out there, okay, but, fast food, not going to die. Can't replace that. The convenience store, I think you're going to have a tough time kind of replacing the convenience store. But, things like, there's a lot of things out there that are very much changing. And so there's no question that the retail is different, but I think to say that retail is dead is a very short-sighted statement.
Yeah. Well, I tell you what, I'll throw in my 2 cents worth there too. I'm 54 years old. I've certainly got hopefully a long ways to go and lots more learning. The more I learn, the more I realize there is to learn. And one of the things I learned about shifting markets or changing markets is if you take television, going back prior to the late 70s, all we had was ABC, CBS, NBC, and 1 or 2 VHF channels, basically 5 channels in any marketplace. And when cable came out, everybody was like, well, that's the end of traditional commercial television. But it really didn't end it. What it did is it just added another segment of the market. In other words, cable became another segment. All right, and if you think about it, it's even happened again with Netflix and Hulu, and you can buy movies on Amazon.com. That did the old DVD rental business that you go to the store to rent out. That certainly dried up, but that I think is an exception. However, they have Redbox now, so that's one example. The other thing was like the telephone. Offices everywhere still have landlines, and yet we all have cell phones. So in any case, markets will change, and it's the same thing with real estate. People thought, okay, well, once the internet kicks in, we won't need agents anymore. That's really didn't happen. What happened is it added another layer of lead generation for us and access to consumers, but the relationship component of our business hasn't changed at all. It's still there, So when I see those things, yes, sometimes an industry could dry up and fade away, but in most cases, what it does, it just adds another segment to the marketplace. In any case, here's another question from Faisal Khan, one of our great agents up in Patterson, New Jersey, and a man in blue. So thank you, Faisal, for serving your community. And here, Faisal is asking, just curious, how hard is it to get into triple net lease as an investor? So just to give you a perspective, so Faisal is in an area where outside of New York City, certainly a good hot investor community, flipping homes, people buying duplexes, fourplexes, triplexes. And probably I would say you could buy a fourplex for maybe $400,000 or $500,000 out there.
Okay.
But there's certainly a lot of. I mean, by the way, just to preface this before you answer, everywhere I've been, guys, there are businesses, some of the ones that Ken put up in the beginning, that will do triple net leases like the dollar store out in the middle of almost nowhere. So really, wherever you are, you have the opportunities. But back to his question, any advice you can give him as a guy breaking into the business from at the beginning stages,
Yeah, I mean, advice would be to kind of look at a lot of deals, right, to understand it. But use the example of a $400,000 or $500,000, duplex or quadplex there. You can get into these shorter-term Dollar Generals or a little bit older Dollar Generals, and you can find those for kind of that same kind of price range, maybe $500,000-$600,000. The brand new ones, maybe $1.3 to $1.5 million. So the dollar stores are a great kind of entry asset into the triple net investment world, primarily just because of the dollar value that we're talking about here. It's that $1.5 million and less dollar value right there. But it does take some capital to get into them. Folks certainly JV and partner and go into deals together, but it takes a little bit of capital. The beauty of the triple net lease is, or especially the single tenant triple net lease, is it's one lease to understand, and they're fairly, especially once you've read a few of them and you understand what the basic provisions are. Like anything, if it's something you're committed to, you can get up to speed on it relatively quickly. And I would think as an investor, I would want to just kind of look at a lot of packages, look at a lot of rent rolls, and see what they're looking like, and study them and understand them. And at a point, just make a decision and go for it.
Yeah, in fact, so I think in your area, probably JVing, partnering up with other people would probably be a good option for you. Okay, let's see here from Victor. Why would a seller want a low cap rate? I know the answer. Go ahead, if you wouldn't mind, can just explain cap so they understand, the inverse relationship, and that might help Victor understand.
It's interesting. Even I was a CCIM, and I'm still going through this process. Had a tricky time understanding the inverse relationship. I always thought that the more you paid for something, the more return you ought to get for it, right? But that's not the way it works. And so from a seller's perspective, to sell on a lower cap rate means that his sales price is going to be higher. And the seller, of course, wants to sell high. The buyer wants to buy low. And so using that $100,000 example of a sales price with a $10,000 income, the seller would want a lower cap rate. For instance, if the seller sold that property at a 10 cap and they had a $10,000 income, that's a $100,000 sales price. If the seller could sell it for $200,000, that would be a 5 cap on the property. Now, what kind of properties trade at a 5 cap? Well, Chick-fil-A, McDonald's trades even lower than that right now, but Chase Bank, those type of properties will trade at a 5 cap or better, really gold-plated credit. And so again, the seller just wanted to sell for as much money as they can, and given that there's a fixed net operating income that's in place, the more money he sells it for, the lower the return to the buyer.
Excellent. Okay. One more from Willa too. She's asking, do you build on a lot or do you use existing buildings or both?
Both. Okay. So there could be just a new build. Like all the tenants will have prototypes that they prefer to just ground up build their prototypes. But sometimes there's an existing structure in place where it makes sense to go rehab the existing. It's just more cost effective to go rehab the existing structure. So either one could happen.
Okay. And we got one more just snuck in there. Maria. Hey, Maria, how you doing? Maria Banks. Okay, what was the name of this class for the survey? What was the name of this class for the survey? I'm not sure.
Oh, the name of the survey is, the name of the class. I'm sorry. Net Lease, Triple Net Investing 101 or Net Lease 101. Net Lease Investments. There's 4 classes on there. I think I do. But it's, Triple Net Investing or Net Lease 101, I think.
Okay, good. And I think that actually wraps it up. Okay, got it. At least 101. Okay, thanks, Maria. Well, listen, Ken, I think I speak for everybody, and actually they're coming in thank yous because I know they're nearing the end of the hour here. But, man, I just want to thank you again for taking your precious time to share with us. It looks like a lot of these guys got a lot out of this, and it is being recorded. So, Ken, we're going to send this out to the group tomorrow, which is probably close to 1,000 people, and you're going to get a copy also from Beverly. Ken, you can certainly use it on your own efforts. Great presentation, well presented. You're getting a lot of good kudos here, brother.
Well, thank you for having me. I appreciate it.
Yeah, this was awesome. And I love, if you have any questions, Ken, obviously give me a call anytime. We can touch base, but you should see this tomorrow from Bev. And for everybody else on the call, you'll look for the recording, take notes, get those books. I mean, Ken's offering you a bounty of $500 for doing something that's only going to benefit you. So that's pretty awesome. There you go. Yeah, but to everybody, thank you for participating. I hope you have an awesome week here. God bless all of you, and I will look for you on next week's webinar. Okay, take care and God bless. Bye-bye.